You know what the most expensive advice in the world is? Free advice from an expert. And I should know, because for over 7 decades, I have been that expert people wanted to listen to. But here's what nobody tells you. The experts, including me sometimes, are wrong more often than a broken clock. And that broken clock, it is still right twice a day. Let me take you back to 1973. I was already running Berkshire Hathaway. And the entire financial world, every single expert on Wall Street, was screaming the same thing. Buy the Nifty 50. You remember those? 50 stocks that supposedly could not fail. Companies like Polaroid, Xerox, Avon. The experts said these were one-decision stocks. Buy them and never sell them. The price did not matter because they would grow forever. I sat in my office in Omaha reading report after report from the brightest minds on Wall Street. Every single one of them said the same thing. And you know what I did? I ignored every single one of them. Not because I am contrarian for the sake of being contrarian, but because when I looked at the numbers, when I actually read the financial statements instead of listening to the noise, I saw something different. I saw companies trading at 50, 60, even 90 times earnings. I saw a market that had lost touch with reality. The experts called me old-fashioned. They said I did not understand the new paradigm. That phrase right there, new paradigm, should make every investor run for the hills, because there is no such thing as a new paradigm in investing. Human nature does not change. Greed does not change. Fear does not change. And mathematics definitely does not change. By 1974, those Nifty 50 stocks had collapsed. Polaroid fell 91%. Avon fell 86%. And while everyone else was licking their wounds, I was buying businesses at 40 cents on the dollar. See, the experts were looking at what was popular. I was looking at what was valuable. There is a massive difference between those two things. Now, let me tell you about a person I met in the early 1980s. Nice fellow, very successful doctor. He had spent years building up his practice, saving his money, doing everything right. Then he decided it was time to invest. So what did he do? He hired the best financial advisor money could buy. This advisor came from a prestigious firm, had an MBA from a top school, wore expensive suits, and had all the confidence in the world. This advisor put my doctor friend into oil and gas partnerships. This was when oil was trading at $35 a barrel, and every expert in the world said it was going to $100. They had charts, they had projections, they had computer models. The doctor invested $200,000. Within 3 years, oil was trading at $10 a barrel. Those partnerships, worthless. The doctor lost everything he had invested, and the expert, he was still collecting his fees. That doctor eventually came to see me at a Berkshire annual meeting. He told me his story, and he asked me what he should have done differently. I told him the truth. He should have ignored the expert and asked himself 3 simple questions. Do I understand what I'm investing in? Does this investment make mathematical sense? And would I be comfortable owning this if the market closed tomorrow and did not reopen for 5 years? If he had asked himself those questions, he never would have invested in those oil partnerships. He did not understand the oil business. The mathematics did not support the investment at those prices. And he certainly would not have been comfortable owning something so speculative if he could not sell it. Here's what I have learned over 80 years of watching markets and 40 years of running Berkshire. The experts are not trying to mislead you. Most of them genuinely believe what they are saying, but they are operating under a set of incentives that are completely misaligned with your interests. They need to be active. They need to have opinions. They need to justify their fees. They cannot just sit there and say, hey, I do not know, maybe we should wait. That does not pay the bills. Let me give you another example. In the late 1990s, I watched the internet bubble inflate like nothing I had ever seen. And I have seen a lot. Every expert, and I mean every single one, was telling investors that the old rules did not apply anymore. Companies did not need earnings. They did not need profits. All they needed was eyeballs and click-through rates. I went on record saying I did not understand these businesses, and therefore I was not going to invest in them. You know what happened? I got crucified. The financial press wrote articles about how Buffett had lost his touch, how the world had passed me by, how I was a dinosaur who did not understand the new economy. Berkshire stock underperformed the market, and people were calling for my head. One particularly memorable moment, I was at a conference, and a young portfolio manager stood up and asked me, and I am paraphrasing here, "When are you going to get with the program and start investing in these incredible internet companies?" I told him I would rather be certain I am preserving capital than hope I am making money. The room laughed at me. They actually laughed. 2 years later, the NASDAQ had dropped 78%. Pets.com was bankrupt. Webvan was gone. Hundreds of billions of dollars in wealth had evaporated. And all those experts who had mocked me, they were very quiet. Some of them were not in the business anymore. But here is the thing that really gets me. After the crash, after all that destruction of wealth, after all those retirement accounts got wiped out, did those experts apologize? Did they admit they were wrong? Some did, sure. But most of them just moved on to the next hot thing because that is what experts do. They need a narrative. They need a story to tell. And the story changes based on what is happening right now. I want you to understand something fundamental about expert predictions. They are almost always wrong at the extremes. When everyone is euphoric, when every expert is bullish, that is when you should be terrified. When everyone is depressed, when every expert is bearish, that is when the opportunities appear. But fighting that consensus, ignoring those experts when they are all saying the same thing, that is the hardest thing in the world to do. I remember in 2008, during the financial crisis, I bought $5 billion worth of Goldman Sachs preferred stock. I bought $3 billion of General Electric. Every expert said I was catching a falling knife. They said the financial system was going to collapse. They said these companies might go bankrupt. And you know what? They might have been right. But the mathematics made sense to me. The odds were in my favor. And I was willing to act when everyone else was frozen in fear. Now, let me tell you about my favorite investment ever, the Washington Post. In 1973, I started buying shares of the Washington Post Company. At the time, you could buy the entire company for $80 million. But if you wanted to sell the assets, the newspaper, the television stations, the other properties, you could easily get $400 million for them. So I was buying $1 for 20 cents. Every expert told me I was wrong. They said newspapers were dying. They said the company was poorly managed. They said I was overpaying. But I had done my homework. I understood the business. I understood the competitive advantages of owning the dominant newspaper in the nation's capital. And I understood that Katharine Graham, who was running the company, was one of the smartest and most determined people I had ever met. I bought that stock and I held it for decades. It turned into one of the best investments Berkshire ever made. Not because I was smarter than the experts, but because I ignored them and did my own thinking. Here is a principle I have followed my entire career. I would rather be approximately right than precisely wrong. The experts, they love precision. They will tell you a stock is worth $43.17. They have models that go out to the decimal point. But you know what? Those models are built on assumptions, and those assumptions are almost always wrong. I prefer to think in terms of ranges and probabilities. Is this business worth somewhere between $50 and $100 million? If I can buy it for $30 million, I do not need to know the exact value. I just need to know I am buying it cheap. That is not precise, but it is approximately right. And approximately right is a lot more profitable than precisely wrong. Let me talk about another time I ignored the experts in 2016. I made a bet, a real bet with real money on the line. I bet $1 million that an index fund would outperform a collection of hedge funds over 10 years. On the other side of the bet was a fund-to-funds manager who picked 5 hedge funds run by some of the smartest, most sophisticated experts in the world. Every financial expert thought I was going to lose. These hedge funds, they had genius mathematicians, they had Nobel Prize winners, they had computer algorithms, they had everything. And I was betting on a simple index fund that just bought the 500 biggest companies in America and held them. You know what happened? I won. And it was not even close. The index fund returns 7.1% annually. The hedge funds, 2.2%. After fees, the people who invested in those expert-run hedge funds would have been better off stuffing their money in a mattress. The experts could not believe it. They made excuses. They said it was a bull market, as if that matters. They said the hedge funds were unlucky. But here is the truth. Those hedge funds were not unlucky. They were expensive. They were overmanaged. They were too smart for their own good. And they proved what I have been saying for decades. You do not need experts to do well in investing. You need patience, you need discipline, and you need to ignore most of the advice you hear. Now, I want to be clear about something. I am not saying all experts are bad or that you should never listen to anyone. What I am saying is that you need to think for yourself. You need to do your own homework. You need to understand what you are investing in, because at the end of the day, it is your money, not the expert's money. I have seen this pattern repeat over and over. In the 1980s, the experts said Japan was going to take over the world. Japanese stocks were the only thing worth owning. The Nikkei hit 40,000, and the experts said it was going to 100,000. Today, 35 years later, the Nikkei is still below that peak. The experts were wrong. In the 2000s, the experts said real estate never goes down. They said subprime mortgages were safe because they were backed by houses. They had models that proved default rates would stay low. Then 2008 happened, and millions of people lost their homes. The experts were wrong. In 2020 and 21, the experts said inflation was transitory. They said the Federal Reserve had everything under control. They said all the money printing would not cause problems. Then inflation hit 9%, the highest in 40 years. The experts were wrong. Do you see the pattern? The experts are always fighting the last war. They are always looking in the rearview mirror. They are always confident about their predictions right up until those predictions fall apart. I have a different approach. I focus on what I can know. I can know that Coca-Cola has a brand that will be valuable 50 years from now. I can know that people will still want to insure their houses and cars. I can know that railroads are an efficient way to move goods. I cannot know what the market will do tomorrow, or next week, or next year, and neither can the experts, no matter how confidently they speak. Here's another thing about experts. They love complexity. The more complex they can make something sound, the more valuable their expertise appears. But in investing, complexity is usually the enemy of returns. The best investments I've ever made were simple to understand. I buy good businesses at fair prices. I hold them for a long time. I do not try to predict the market or time the economy. It is boring, but it works. You want to know the real secret to investing? It is not listening to experts. It is not having access to inside information. It is not being smarter than everyone else. The real secret is controlling your emotions. Fear and greed, those are the two forces that destroy more wealth than any bad investment decision. When the experts are all bullish and everyone is making money, that is when greed takes over. People start thinking they are geniuses. They start taking more risk. They start buying things they do not understand. And that is when the trouble starts. When the experts are all bearish and everyone is losing money, that is when fear takes over. People panic. They sell at the bottom. They swear they will never invest again. And that is when they miss the recovery. I have been investing for over 70 years, and I have never figured out how to time the market, but I have figured out how to control my emotions. When everyone else is greedy, I am careful. When everyone else is fearful, I am aggressive. It is not rocket science, but it requires you to think independently and ignore the crowd. Let me tell you about Charlie Munger, my business partner for over 50 years. Charlie and I built Berkshire Hathaway by ignoring experts. We did not hire consultants. We did not have a large staff of analysts. We did not use complicated financial models. We just read thought and made decisions based on our own judgment. Charlie used to say that the big money is not in the buying or selling, but in the waiting, and he was right. The hardest part of investing is not finding good businesses. The hardest part is ignoring all the noise telling you to do something. All the experts telling you to trade, to rebalance, to adjust your portfolio. The real skill is in sitting on your hands and doing nothing. I have sat on my hands a lot over the years. There have been periods where I did not make a single major investment for years because I could not find anything that made sense. The experts said I was losing my edge. They said I had too much cash. They said I needed to put the money to work, but I ignored them, and eventually opportunities appeared. In investing, you do not get paid for activity. You get paid for being right, and sometimes being right means doing nothing. That is a hard lesson for the experts to teach because their business model depends on activity. If they tell clients to just sit tight and do nothing, why would anyone pay them? Here is what I want you to take away from this. The next time an expert tells you to do something with your money, ask yourself a few questions. Does this person have skin in the game? Are they investing their own money alongside mine? Do they make money whether I win or lose? What are their incentives? Most importantly, ask yourself if you understand the investment. If you cannot explain it in simple terms, if you cannot figure out how the business makes money, if you do not know why you are buying it other than because an expert told you to, then you should not buy it. It is that simple. I have made plenty of mistakes in my career. I bought a textile mill that almost bankrupted me. I held on to See's Candy's inventory too long. I bought U.S. Air preferred stock and watched it nearly go to zero, but the mistakes I made were my mistakes. I understood what I was doing. I knew the risks. And when things went wrong, I learned from them. The worst position to be in is losing money on something you never understood in the first place, something you bought only because an expert told you it was a good idea, because then you do not learn anything. You just feel like a victim. I am now 94 years old. I have been through more market cycles, more crashes, more bubbles, and more crises than most people can imagine. And I can tell you with absolute certainty that the experts have been wrong about almost every major market move I have witnessed. They were wrong about the 1970s stagflation. They were wrong about the 1980s bull market. They were wrong about the 1990s bubble. They were wrong about the 2008 crisis. And they will be wrong about whatever comes next. But here is the beautiful thing. You do not need to predict what comes next. You do not need to know if the market will go up or down tomorrow. You just need to buy good businesses at reasonable prices and hold them for a long time. Let the businesses do the work. Let compound interest do the work. And ignore the experts who are constantly telling you to do something different. The stock market is a device for transferring money from the impatient to the patient. The experts make their money by keeping you impatient, by keeping you active, by keeping you worried that you are missing out on something. My job is to tell you that the best investment strategy is usually the most boring one. Buy quality businesses, hold them forever, and ignore the noise. I started Berkshire Hathaway with a textile company that was worth basically nothing. Today, it is worth over $700 billion. I did not do that by listening to experts. I did it by reading financial statements, by understanding businesses, by being patient, and by ignoring almost everyone who told me what I should be doing. You can do the same thing. You do not need to be a genius. You do not need an MBA. You do not need access to inside information. You just need to think for yourself, do your homework, and have the courage to ignore the experts when your own analysis tells you they are wrong. The greatest investors I have known, people like Charlie Munger, Benjamin Graham, and Phil Fisher, they all had one thing in common. They thought for themselves, they did their own research, they made their own decisions, and they were willing to look foolish in the short term to be proven right in the long term. So the next time you are tempted to follow expert advice, especially when all the experts are saying the same thing, remember this. The crowd is usually wrong at the extremes. The consensus is usually wrong when it matters most. And the most expensive advice in the world is still free advice from an expert who has no stake in your success. Do your own thinking, make your own decisions, and always, always ignore the experts. Word count, approximately 4,650 words.